Imagine for a second that you're a detective, but instead of solving a crime, you're trying to solve the market. You're out there looking for clues, trying to find those hidden signals that everyone else is completely missing, mostly because they're looking in all the wrong places. Today, we're analyzing an incredibly dense quantitative source of market intelligence called the Regime Report, specifically focusing on its May 30th analysis of ratio alerts and the Iran ceasefire rotation. Okay, let's dive into this explainer and crack the case. Here's our roadmap for today. We'll start with how prices conceal and ratios reveal, then look at the statistical rubber band, unwinding maximum market fear, 3 high-conviction trades, and finally, the ultimate risk factor. Section 1. Prices conceal, ratios reveal. Now, if you're only looking at standard price charts, you're basically flying blind to the actual structure of the market. Because, as the report perfectly points out, ratios reveal what individual prices conceal. Think about it. When you look at just the price of gold or the price of oil in total isolation, you're only getting half the story. The true deep market insights, the ones that actually give you a real edge, they're found in the relationship between assets, not just their isolated price tags. So think of a ratio chart as your financial magnifying glass. By dividing one asset by another, you're no longer looking at a price anymore, you're looking at a relationship. And the absolute magic happens when that relationship gets pushed way too far, when those extremes are reached. The framework flags it for us, telling us exactly which leg of that relationship has to inevitably adjust. Section 2. The statistical rubber band, stretching to extremes. Here's the mathematical edge of our investigation, plus or minus 2 standard deviations. In the world of the Regime Report, when the divergence between two assets hits this plus or minus 2 standard deviation mark from their mean, that rubber band is stretched to its absolute, agonizing limit. It just cannot stay there. One side is going to snap back. To really put that into perspective, picture a normal market. It sits comfortably inside its Bollinger Bands. It's balanced, calm, kind of predictable. But an extreme market, one sitting beyond that 2 standard deviation line, it's a whole different beast. The tension is palpable. It's a mathematical anomaly literally screaming for a statistical correction. And right now, we're seeing an incredibly rare amount of tension out there. Section 3. Unwinding maximum market fear. Multiple active alerts. Just look at the master alert scorecard right now. Multiple clues are flashing simultaneously. Out of 18 tracked ratios, 6 are sitting at active or near alert levels, all at the exact same time. This is wildly rare. We've got copper to gold at minus 1.8 standard deviations flashing a recession warning, gold to the DXY dollar at a screaming plus 2.3 standard deviations, and platinum to gold sitting at extreme multi-decade lows. But I want to focus your attention on one specific extreme, the gold to crude oil ratio, which is currently sitting at plus 2.1 standard deviations. The ratio is actually at 52.3 against a historical mean of roughly 20. That means this relationship is currently a staggering 161% above its historical average. That rubber band is practically snapping as we speak. So why is this happening? Well, we're seeing a violent juxtaposition in the market. Gold has been driven straight through the roof by monetary fear and central bank buying. Meanwhile, oil is rapidly unwinding its war premium. And the catalyst pulling the pin on this entire setup, the May 29th Iran ceasefire. Market fear is directly colliding with geopolitical relief, and it's creating this massive mathematical divergence. Section 4. 3 high-conviction trades. Theory to execution. So the crucial point is, theory is great, but execution is everything. Trade number 1 targets the platinum to gold ratio, which, as we saw, is currently sitting at minus 2.1 standard deviations. Simply put, platinum is historically incredibly cheap compared to gold right now. We're talking multi-decade lows here. Here's the exact setup. The entry condition is triggered when the relative strength index drops below 30, and the stochastic oscillator drops below 20. When that happens, your action is to go long platinum and short gold. But the report is very clear on a structural caveat here. The rise of battery electric vehicles is seriously disrupting auto-catalyst demand for platinum. Because of this structural headwind, you've absolutely got to trade this with a smaller position size. Moving to our next 2 high-conviction setups. Trade 2 goes after that active gold to dollar extreme. You want to short the ratio, meaning reduce gold or go long the dollar, specifically when the stochastic's K line crosses below the D line from up above the 80 level. Trade 3 is a meaner version play on the DAX versus the S&P 500. The German DAX is cheap right now. The execution here is to go long the DAX and short the S&P when the RSI drops below 40 near the lower Bollinger Band. These are rapid-fire, highly actionable execution parameters, so definitely screenshot this for your notes. And this brilliantly illustrates the broader structural shift happening right beneath the surface. It's all connected in what the report calls the ceasefire rotation. Watch how it flows. Gold gives back its fear premium. Oil starts to recover from its brutal 17% monthly drop. The stretched equities to bonds ratio finally compresses, and European equities like the DAX catch up to their American counterparts. It's a beautifully logical unwinding of maximum tension. Section 5. The ultimate risk factor. Anticipating the twist. Now, as any good detective knows, you can't solve the case without anticipating the twist. With so much capital flowing into these mean reversion trades right now, what is the single specific event that shatters this entire setup? According to the source material, the ultimate tail risk is this. Trump rejects the Iran ceasefire memorandum of understanding. If this geopolitical event occurs, the report details a brutal sequence. Oil instantly respikes to over $110 a barrel. The gold-to-dollar ratio blows out to an unprecedented +3 standard deviations. Every single rotation we just discussed reverses violently within 48 hours. You must have your risk parameters set for this exact headline. I'll leave you with this phenomenal quote from the author of the report, Purvan Gandhi: "The trader who prepares on the weekend owns the week." We've just analyzed 18 ratios, pinpointed the statistical extremes, and mapped out exact execution triggers and tail risks. The data's out there, waiting for us in the relationships between assets, not just their prices. So apply these frameworks, stay objective, and keep exploring the data. Thanks for joining me on this explainer, and I'll see you next time.